Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I want to walk you through some of the most interesting financial market themes that I'm observing. So, a lot of news coming out. We had earnings. We had the big Fed announcement this week. The Fed is pausing again. Let's talk about the implications of that. And then precious metals, specifically gold and silver, have been on quite the rally during the past year, especially during the past 6 months. And then finally, consumer confidence report came out. Despite consumer spending remaining pretty resilient, consumer confidence reached a new 12-year low. So the Fed is pausing again. On Wednesday, the Federal Reserve finished up their 2-day meeting, and not to any surprise to market participants, the Fed did not continue to cut rates. In fact, after cutting rates during the previous multiple meetings, the Fed left the Fed funds target rate range between 3.5 and 3.75%. On the chart here, you can see in the dark blue is the upper bound of that Fed funds rate at 3.75%, and CPI year over year is the inflation rate, which is around that 2.7, 2.8%. As of December, we haven't received or won't receive January's report for a couple weeks now. Now, the long-term target for the Fed's inflation is around 2%, but right now the Fed is going to pause because they've said that the solid growth and consumer spending and somewhat stabilizing labor market and potential concern for the inflation number not being down to its 2% target, all of that weight of the evidence has led them to pause. 10 committee members said to pause, 2 dissented. Most notably, one of them is a potential candidate for the next chair from Trump. So all that to say, not a surprise. Market took it in stride. If you looked at the summary of economic projections from their December meeting, the Fed only forecast 1 cut for this year. So most participants expected this pause, and we received it. Now, one thing that is not pausing is gold and silver prices, which continue to surge. This is a 6-month return chart for both spot price of gold and silver. So you can see silver over the past 6 months has increased in value by 192%, whereas gold has increased in value 60%. Now, precious metals have been among the top performing major commodities. Silver especially doing very well. Now, when you talk about what are the tailwinds, we've seen increased potential geopolitical risk throughout 2025 and even escalated during recent months as well. You can think of metals as somewhat of an inflation hedge as market or consumers start to continue to worry a little bit about inflation not reaching the Fed's target or potentially bubbling up from tariffs, which we haven't necessarily seen so far. And also, there is an industrial use for specifically silver and solar panels, electronics, and electric vehicles. But one of the other tailwinds is you really have seen central bank spending, specifically around gold, not so much silver, gold during the past several years. Structurally, we've seen central banks around the world increase their purchases in gold as a reserve. In fact, about twice the pace of what they did during the previous decade. So that's an underlying structural demand for gold and silver. But we've also seen a lot of speculative investments in these areas from investors trying to profit on that trend. And the question is it sustainable? Take a look at this chart. This is silver prices, which tend to be a little more volatile than gold. They are unlike anything we've ever seen. And what I mean is this is a ratio between the price per ounce of silver. So how much does an ounce of silver cost compared to 1 barrel of WTI crude? So we're looking at 2 real assets, the price of silver over the price of crude. And historically, since 1946, almost the entirety of these two real asset prices, the price per ounce of a silver is cheaper than a barrel. In fact, the long-term average is around 0.34. So it's about a third of the price of a barrel of WTI crude. Right now, that ratio is up to 1.8, which means 1 ounce of silver cost 1.8 barrels of WTI crude. That ratio is unlike anything we've ever seen. We had a silver bubble back in the early 80s during a shortage of silver. That was the only other time it actually went above that one threshold. So when you look at this threshold of silver prices compared to oil prices, the question is it something structurally different just based on the industrial demand, or do we have a massive dislocation? I would probably lean toward the latter. I don't think this is especially when you look at the industrial usage of silver. Yes, it is perhaps a little increase given the shift in technological demand and some of the spending in those industries. But most of this is just a surge in investments in this metal during the past 6 or 12 months. And you can look at that relationship relative to oil prices. I would think you would see some sort of a reversion to the mean at some point in the next 12 to 18 months. Now, we talked about consumer confidence and consumer spending. Spending has actually been a tailwind for the economy. But take a look at this Conference Board's Consumer Confidence Index based on expectations of U.S. consumers. It plunged to a 12-year low of 84.5. That was much lower than economist expectations. And when you look at the chart, this is the lowest level that we've seen since 2014, almost 12 years. Most notably, consumer confidence is actually lower than it was in the midst of the pandemic. It's lower than it was in the midst of tariffs. Now, this is difficult to say exactly what this means because we've actually seen consumer spending and retail sales very strong. And one of my theories is that when you look at consumer spending, the wealth inequality and wealth concentration has reached historic levels. If you look at the top 10% of earners, they are responsible for 50% of consumer spending. And I think when you look at a survey like this is going to probably give you most of consumers' confidence from that 0 to 60% earners, more of that median. And so I think there is a situation where high income earners are still doing very well. Home prices have surged. Stock markets are doing well. So their assets and accumulation have done very well. And their spending has been still very, very resilient for this economy. And corporate earnings have certainly been strong. But I think there is a pocket of the economy and consumer that spending is not as strong, and perhaps they don't have as great of an impact on the economy, but we are having this dispersion between consumer confidence and spending, and it will be interesting to see if we see any kind of sync up to those, because historically we have, but we are seeing this dislocation between these during the past year or so, and it's an interesting, at the very least, an interesting data point to keep an eye on. Now, speaking of sort of expectations and the markets, we've kicked off the earnings season over the past several weeks for fourth quarter, and we're starting to receive some reports from 4 of the Mag 7 companies, and it's been a bit of a mixed bag. You had Facebook and Tesla beat on earnings and revenue estimates, which was good. Both of them talked about big spending in AI. In fact, Facebook expects to spend $135 billion in 2026 on AI spending. That was in excess of what analysts expected, and they were sort of reducing their spending in that metaverse. So analysts cheered that and rewarded that stock with upward prices. They also cheered Tesla for the most part. Microsoft, not so much. Microsoft had huge contraction this week in value, the largest we've seen from one of these large cap growth names since NVIDIA, in response to that sort of DeepSeek AI threat back over a year ago. So big contraction of Microsoft. The negative news there is that cloud revenue not really beating expectations. They're still spending a lot of money on AI. We haven't seen the return on that investment. There's also a bit of a concern around these software companies. Software, that sector specifically, is in a bit of a bear market because a lot of concern around what these AI tools might do to replace sort of the traditional software providers, and Microsoft's right at the top of the mountain of those software providers. Apple also came out with earnings. iPhone sales, surprisingly, after a lackluster holiday season, big surge in demand in iPhone sales. So altogether, I'd say mixed results, but there's no doubt that AI companies, or these big Mag 7 companies, continue to spend a lot of money on AI, and that continues to remain one of the big themes and concerns around this market is, will these big cap companies that the market is so concentrated in receive the return on investment from this massive spending in AI? With that, I want to thank everyone for watching, and I'll see you next time.